to discuss some of the major themes that are going to be shaping economies and markets this year, from Trump to the size of the US deficit to the strength of the dollar and the future of globalization. I'm joined now by Stephen Jen. He is CEO of Eurizon SLJ. Stephen, it's great to have you with us. I want to get into some of those big economic issues in a second. Before I do, tell us a little bit about your career as an economist.
Yeah, sure. Well, first of all, thanks for having me. Maybe I should just say I'm Taiwanese Chinese. I studied in the US, studied actually electrical engineering at first, and then for my graduate studies, I did macroeconomics in the US. Then I worked for the IMF for 4 years before joining Morgan Stanley. I was there for 14 years. I was the global head of currency research. Then I left Morgan Stanley, joined a hedge fund, then started my own hedge fund, and then the fund was bought by an Italian bank, Intesa Sanpaolo, and this is our entity, Eurizon SLJ. Eurizon is their asset management arm, and you know we're basically their branch here. We still own a minority stake in the company. We specialize in emerging market assets, bonds and equities, currencies. And as an economist, I'm very global in the way I look at things. You know, I don't just look at Brazilian macro variables when I trade Brazil. It's really the Fed, the ECB, the BOJ, everybody. Everything is put together in the pot, and you know we come up with we map economic trends into trading opportunities in EM.
I wanted to come back to Trump, if I may. I mean, we're talking just before his inauguration. I think one thing that's fair is no one's quite sure what he's going to do, but there does seem to be a bit of a consensus at the moment that he's probably like to be quite a big spender. I just want to get your thoughts. As I said, we don't know what's going to happen, but how well priced is that as a bet? And what happens if you look to the other side and say, well, what if he's not a big spender? What if he's one of life's savers? And how well is that priced as an opportunity?
It's one of the key questions in the market now, but it hasn't been much of a debate, unfortunately, but it will be, in my view. So I think, to answer your question, the market is pricing closer to 100% than 50% that Trump 2.0 will entail a fiscal posture that is aggressive, big, and quite inconsistent with what the market needs. So that's the assumption. I'm on the other side. Personally, I think the risk of us seeing a smaller government posture are higher than what the market believes. First, let me start with just observation, really. DOGE, right? DOJ, Department of Government Efficiency. DOGE was actually announced on November 12th, only 7 days after the election. So if Trump were really a profligate fiscal spender, I don't think he would have, had the time to think about. First of all, come up with the idea of DOGE, and actually announce it so early after the victory. So it had already been considered, and I think there are maybe two reasons why. The first reason is inflation. Inflation we now have seen, is political poison. So we can go back in history in the U.S. Ford lost in 1976. Carter lost 1980. And then Biden lost 2024. So for Trump to have secured a victory on the argument, mainly on the argument of inflation, only for him to go back to implement policies that will ultimately lead to inflation it's just a strange concept, to me. So that would be one thing. As I said, inflation is political poison. They should know that. The team should know that, and that explains DOGE. The other obvious threat, of course, is the pressure from the Bond Vigilantes. We can talk about the debt profile, but that is going to be an issue as well.
Well, let's look at Bond Vigilantes then. I suppose one thing people might say is, well, the States is the linchpin of the entire global order. It's got the power of the dollar behind it. things have got to get really out of whack before the bond vigilantes are going to be big enough and strong enough to take on the Fed. I mean, they can have a crack at a medium-sized country like the UK, which they did it when Liz Truss was Prime Minister recently, but that's just not going to happen with the US.
Fair. The US has a currency, the US dollar, that is the hegemonic currency in the world. The Fed is the central bank for the world. It's one country, the only superpower in the world that possesses both hard power and soft power, military power and soft power, cultural influences. Europe has soft power, not hard power. China has the other, hard power, not soft power, but US is the only one that possesses both. So in many ways, that argument is valid, that the threshold of tolerance of the bond market seems higher, or should be higher in theory, than for the US than for other countries. Having said that, we need to be cognizant of some numbers. So we're sitting, the United States has a debt to GDP ratio of just around 100 now, 100% of GDP. And 5 years ago, before COVID, it was 80. So we've gone from 80 to 100. The next stop is 120. And what 120 happens to be the debt to GDP ratio of Italy in 2011. So whatever we said back then about Italy, Spain, and Greece, well, in a few years' time, on the current trajectory, the US will be in the same situation. Is that prudent? So on the current, I think the CBO, I was looking at the numbers in their projections. They think that in 8 years' time, we'll get to 120. So there's not too much time. I know it's not urgent. The sky will not fall tomorrow. But it takes a long time to turn this supertanker around. And this is why it's quite important for the government to have the foresight and the prudence to take difficult decisions before the time comes. We'll see what happens, but bond yields are higher than they should be. We all know that. We look at the inflation expectations. They haven't risen that much. PCE is at 2.5%. You plot this chart over time, you see PCE is spiking higher. It's come down to 2.5%. Is that really alarming? 2.5? Not really. And GDP is stabilizing at levels below 3% now. Atlanta Fed's GDP now number is now converging down to the market expectations of 2.5% or so. So it's not growth. Growth is not accelerating or not expected to accelerate. It's not inflation. Inflation is not expected to accelerate, but it's everything else. What could this everything else be to have pushed up the US 10-year and also in turn the UK gilt yields? We think it's debt vigilantes. We think it's policy uncertainties. We're afraid of tariffs. We're afraid of some other policies that President Trump may implement.
So what could the US do to run a smaller government? Because someone listening to you might say, well, it all makes sense. But on the other hand, someone's then got to go in there and actually start ripping expenses out. And we live in an older society than what the one was in before. I mean, probably back in the 1950s, there was a lot more young people around. Maybe some of this debt just reflects the fact we're all living longer. You can't go around cutting off payments to granny.
Yeah, totally fair. So the number 65, that's the retirement age in the US. It's popular as a benchmark for other countries in the world. That number actually was put on paper for retirement age in the Social Security Act of 1935. It's been there for a long time. Back in 1935, the life expectancy of the US, men in the US, was 60. So you see the point. Yeah. So now we have a situation where in the next generation, my children's generation, they are expected to live to 100 because of medical, and technological developments that have taken place. That's the projection, at least I've seen. So if that's really the world in 25 years' time, is the number 65 still appropriate? So I take that point totally, and we have to, the society, we have to think about other, issues like can we work for 60 years and postpone our retirement by 20 years? So all these are big issues, but the point is well taken. These developed countries cannot finance the 40-year retirement periods of future generations. So something has to give, and we have to figure that something out. So that's the big picture point. But at a minimum, and also the other issue is, of course, the political difficulties of broaching this issue of Social Security and retirement benefits. But there are other things that can be done. There's a lot of wastage in the government. This is what Doge is about. I compared the concept of Doge to a New Year resolution, like me, getting on a diet program in the new year. And if somebody asked me, where am I going to shed weight? And my answer would be everywhere.
Yeah.
And not one place, right? It's everywhere. So the debate on what should be cut is kind of not really the point of Doge, right? It's about government efficiency. That should not be controversial if we're talking about trimming wastage. I haven't gone through the calculations done by Elon Musk of 2 trillion, but that's a big number. Just to give you some reference as to how big the number is, that's the scale. The budget of the U.S. last year was $6.8 trillion, and just under 1 trillion, 800 some billion, close to 900 billion was interest payment. So if you remove the interest payment, we're talking about 70% of that budget being entitlement spending, leaving 30% for discretionary spending. 30% of just under 6 trillion is 2 trillion. So what Elon Musk said was that, in his view, it's possible to trim fat, inefficiencies in the government by an amount that is the same as the total discretionary spending. It's absolutely massive. I don't know how he came up with the number, and that's one reason why people have doubts. But let's just say that a quarter of that is achieved. That would still go a very long way, because a quarter of the spending is savings that the country could accumulate every single year, and that could lead to very long-term, very material improvements in the trajectory of the U.S. debt profile. So that would be a very valid starting point, in my personal opinion. If the Trump administration is successful in doing that in the first term, it would 2.0 in this term, it would be a tremendous progress. We can leave the Social Security debate for future administrations.
What are your thoughts on where the dollar's heading? Because certainly in the past, Trump has spoken about his desire for a weak dollar, but then I suppose there's a lot of people that are piling their money into the US and US assets, which suggests a much stronger dollar.
Exactly. So for me, I think of the question you asked exactly in those terms, that there are almost like the correct prices in my mind for exchange rates and currencies in two worlds, seen from two perspectives. I call these shadow prices. So for the dollar, there are at least two shadow prices. One that's determined by, as you say, the financial markets. That shadow price for the dollar is very high because the US has fantastic companies, outperforming stocks for many years compared to other countries. Corporate earnings are more attractive in the US, and now high yields. So what's not to like about US assets? So the equilibrium price for the US dollar is very high if you just look at investment opportunities around the world, especially when you have shut off China, the second largest economy and market in the world. If we have concluded that China is uninvestable, well, there's really one or two, Europe, but Europe is more stagnant. It's obvious where global capital should go. The second way of looking, second shadow price, there's a second shadow price, and that's the real shadow price, the real economy shadow price. Where should the dollar be that is consistent with the real economy? And our view is that that level, that value is much lower. So now you have two prices, two shadow prices. You can think of two centers of gravity, and the actual US dollar, where it trades, is gravitated toward one or toward the other, depending on the situation. So if you have say a recession, then the dollar may wake up and realize, oh wait, we shouldn't be here. We shouldn't be at these high levels, and we should go down. So when people say, like me, including myself, when they say the dollar is overvalued, they almost always refer to the second shadow price, because valuation in currency calculations is done through first of the exchange rate, the real exchange rate, not nominal. The financial shadow price is nominal. The real shadow price is determined by real value. So real value regress on real variables such as the terms of trade, the fiscal position, current account position, all these variables that in economists' minds are important, and statistically, empirically, they have been important in determining the dollar value in the past. And using that approach, we find the dollar to be, at this point, not just overvalued by a large amount in terms of the index, but for the first time in many decades, the dollar is overvalued against the widest range of currencies. In the previous episodes, 1980s and before, we also saw episodes of dollar overshoot and undershoot, but it wasn't uniform. It wasn't. Right now, our models suggest that, we track 35 bilateral exchange rates. Out of 35, 33 exchange rates show the dollar is too strong. Only 2 that suggest the dollar is not strong. One is Argentine peso, seems to be strong, and the other one is Bulgarian lev. These are the only 2. Yeah. With all euro, yen, Chinese renminbi, they all seem to be a bit cheap. I'll give you one more metric number, which is more intuitive. So the other day I was looking at the dollar GDP, per capita dollar GDP, so average income in dollars of the 50 United States ranked, and compare them to the dollar GDPs of major economies. And I was shocked. The poorest state in the US now is Mississippi. The second poorest is West Virginia. They're known for being poor. Mississippi now is richer than this country, the UK, France, Italy, Japan. And in fact, the per capita GDP in dollars of California is 3 times that of Japan. To me, intuitively, this is not right. Something is majorly wrong. And one of the sources of discrepancies is the dollar. The dollar is too strong. We see a lot of American tourists. But when you go to the US, you don't see Japanese anymore. You don't see a lot of Europeans. You see Americans here. That, to me, is a reflection of the dollar being way too expensive.
Well, Stephen, we're almost out of time, but if there was one key thing you want to leave us with, that we as investors should be keeping an eye out for the rest of this year, what would it be?
Well, I think maybe we can go back to your first question at the top of this conversation, which is fiscal posture. The market is pricing in quite aggressively a expansionary fiscal stance under Trump 2.0. I would take the other side of the bet. I do think that the bond market will put on so much pressure on Congress and the White House in the first part of the year that we may actually end up with a small government posture, fiscal posture. A lower bond yield will have implications for the dollar, equity markets, oil, and everything else. So I will keep an eye on the bond market, and in turn, what determines the bond market's performance will be the fiscal posture of the US, and the same goes for other countries as well.
We have to leave it there. Stephen, Jen, thank you.
Thank you.